A measured, intriguing change from the Federal Reserve Chair, switching the word addressing for monitoring, can instantly erase billions of dollars from technology stock valuations. This institutional power defines the modern financial landscape. Modern markets operate on a mechanical rule. Interest rates act as the direct gravity for asset prices. When interest rates rise, asset values must fall to maintain equilibrium. The engine behind this relationship is the discounted cash flow formula. In this model, the interest rate, represented by the variable R, sits in the denominator of the equation. Consider a static $100 future cash flow. At a 1% discount rate, the present value remains high. However, at 5%, the denominator expands, and the current value of that same $100 shrinks. Market volatility during a Federal Reserve speech represents a systemic adjustment to a higher denominator. The math mandates a lower valuation the moment the discount rate increases. This brings us to the variable T, representing time or duration. A value stock typically pays out dividends today, at year 1. A growth stock, however, relies on projected profits that may not materialize until year 15. Watch how a 5% rate hike affects both assets. The year 1 value stock takes a minor hit, but for the growth stock, that penalty compounds over 15 years. The exponent creates an exponential drop in current value. Hawkish signals from the Fed disproportionately impact hypergrowth and technology valuations as their distant cash flows face the heaviest compound discounting. The central bank utilizes this sensitivity through forward guidance. Investors do not wait for a physical change in interest rates. They adjust their models based on the Fed's public intentions. Intraday trading data reveals how this anticipatory pricing works. We see a directional move at 2 p.m. when the written statement is released, followed by a sharp reversal at 2:30 p.m. during the unscripted press conference. Algorithmic bots scan the Q&A for keywords like sticky or overheating. Upon detection, these models instantly recalculate the discount rate, triggering millisecond drops in asset prices. Modern trading behavior reflects the anticipated future cost of money. Investors price the Federal Reserve's reaction function as the primary driver of global asset values. This systemic dependency began after the 2008 financial crisis. By lowering rates to zero and initiating quantitative easing, the Fed established a safety net known as the Fed put. The 2013 taper tantrum demonstrated the sensitivity of this new system. When Chair Ben Bernanke nearly suggested reducing bond purchases, global markets and emerging economies entered an immediate panic. The 2020 pandemic response flooded the financial system with cheap liquidity. When the Fed pivoted to aggressive rate hikes in 2022 to combat inflation, it triggered a violent repricing of the resulting everything bubble. 15 years of zero-bound interest rates have conditioned an entire generation of market participants. This has created a structurally fragile market that relies on central bank liquidity to sustain valuations. Traditional logic suggests that strong jobs and high GDP growth are good for corporate profits. In the current market, however, robust economic data is often viewed as a systemic threat to asset prices. Consider a scenario where GDP hits 4.5%. Pause here and predict the subsequent chain reaction for Fed policy, bond yields, and technology stocks. Here is the result. The Fed adopts a hawkish stance to fight inflation. The 10-year Treasury yield surges, and tech stock valuations crash. When markets are addicted to cheap money, economic health signals a restriction of future liquidity. This leads to a mathematical re-rating of assets. You can audit your own exposure to these forces using a 5-step monetary sensitivity checklist. Step 1 is to assess your portfolio's duration to determine your growth exposure. Step 2 is to monitor the 10-year Treasury yield as the primary barometer of market gravity. Step 3 involves tracking the Fed's dot plot for forward guidance. Step 4 requires accounting for quantitative tightening, which drains the liquidity needed to support alternative assets like cryptocurrency. Step 5 is to prepare for press conference volatility. Wait for the algorithmic repricing that occurs during the Q&A session, rather than trading the initial statement. The global financial system currently acts as a mathematical projection of tomorrow's cost of capital. every fluctuation is a direct reaction to the anticipated availability of central bank liquidity.